Margin of Safety, Risk-Averse Value Investing Strategies for the Thoughtful Investor. Book summary by Seth Klarman. Ever felt like Wall Street is just a giant casino where the house always wins? Where brokers are the dealers, and the odds are stacked against you from the moment you place your bet? Well, today we are diving into one of the most eye-opening investment books ever written. Margin of Safety by Seth Klarman. This isn't your typical get-rich-quick manual. In fact, Klarman's all about not getting poor slowly by avoiding the traps Wall Street has set for the unsuspecting. If you're tired of risking your hard-earned money on Wall Street's latest fads, stick around, because Klarman's strategies might just save your portfolio. We're talking about a book so rare and coveted that it's sold for over $1,000 a copy online. Why? Because it exposes the dirty secrets of the investment world and teaches you how to play defense before you even think about scoring. Klarman doesn't sugarcoat it. From the very first chapter, he warns that most investors are wandering into Wall Street's battlefield armed with nothing but a slingshot. While brokers and analysts promise you the stars, they're really just loading you up with high-commission stocks and junk bonds ready to explode. It's like walking into a casino and believing the slot machines are rigged for you. Spoiler alert, they're not. Klarman describes Wall Street as a place where speculation masquerades as investing, where financial innovations are designed less to help you and more to fill brokers' pockets with commissions. Remember the junk bond mania of the 1980s? Investors were lured in by high yields, only to see their portfolios implode when reality hit. Klarman's point is clear. The moment you start chasing what's hot, you're already playing a losing hand. But here's the twist. Klarman's not just ranting about Wall Street's flaws. He offers a way out, a strategy that's all about protecting your money first and growing it second. It's called the margin of safety, and it's like having a lifeboat when everyone else is rearranging deck chairs on the Titanic. The idea is simple but powerful. Buy stocks only when they're priced well below their true value, giving yourself a cushion for when things go wrong, as they inevitably will. So if you're ready to stop playing Wall Street's rigged game and start investing with confidence and clarity, keep watching. We're unpacking the strategies, the stories, and the lessons from Margin of Safety that could change the way you invest forever. Alright, let's kick things off with a brutal truth. Most investors are speculators in disguise. They buy stocks not because they understand or care about the business behind them, but because they hope someone else will pay more. It's like buying a ticket to a hot concert you don't even want to attend, just so you can scalp it outside the venue. According to Klarman, that's the fastest way to lose money. He calls it the difference between eating sardines and trading sardines. Now, what does that even mean? Well, Klarman shares this brilliant little story about a time when sardines vanished from the waters of Monterey, California. Speculators started buying and selling cans of sardines, driving prices higher and higher. One day, a buyer actually opened a can to taste the sardines and immediately got sick. Furious, he confronted the seller, who just shrugged and said, "You don't understand. Those aren't eating sardines. They're trading sardines." It's a funny story, sure, but the message is deadly serious. When you treat stocks like those sardines, buying them not for their value but just because you think someone else will pay more later, you're playing a dangerous game. You're speculating, not investing. And sooner or later, someone ends up with a can full of rotten fish. Klarman argues that Wall Street has turned speculation into an art form. Brokers, analysts, financial news channels, they're all pushing you to trade, 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 like a carnival barker at a rigged game. They want you to believe that stocks are just pieces of paper to be flipped, not fractional ownership in real businesses with real value. The more you trade, the more commissions they make, and the less you notice that they're serving you trading sardines on a silver platter. But Klarman insists there's another way. Real investors, he says, look past the noise and focus on what a business is actually worth. Its cash flows, its assets, its prospects. They buy when the price is far below that value, and then hold on patiently until the market catches up. It's not glamorous. It doesn't make headlines. But it works. So before you hit that buy button, ask yourself, am I buying eating sardines or trading sardines? Am I investing in a real business? or just hoping to pass the can to a greater fool? Because at the end of the day, as Klarman warns, the only way to win at Wall Street's game is to refuse to play by their rules. Klarman pulls no punches. He says that Wall Street is built to work against you. Why? Because Wall Street makes money on transactions, not your success. Think of it like a casino. The house doesn't care if you win a hand or two. As long as you keep playing, the odds are in their favor. In this case, the house is your broker, and every time you buy or sell, they're raking in the chips through commissions and fees. Brokers and analysts are often more concerned about their commissions than helping you make smart decisions. Klarman calls them out for what they really are: salespeople in suits. Ever notice how they're always pushing you to buy, but almost never say sell? That's not a coincidence. Wall Street has a relentless bullish bias because, let's face it, optimism sells. No one gets excited about a hold or a sell rating. When was the last time you heard a broker say, "Hey, maybe keep your money in cash for now"? Exactly. Investment banks score massive fees from underwriting new stocks and bonds, which only happens when markets are rising. Analysts. They're supposed to be referees, blowing the whistle on overpriced stocks. But in reality, they're more like cheerleaders, waving pom-poms and shouting, "Buy, buy, buy." Why? Because if they dare to issue a sell rating, they risk upsetting the very companies that pay their firms millions in investment banking fees. It's a little like a food critic who won't admit the soup is bad because the restaurant owner picks up the tab. Klarman doesn't hold back when exposing this cozy relationship between Wall Street and the companies it covers. He points out that analysts are under enormous pressure to keep their reports optimistic. A negative rating can not only jeopardize investment banking deals, but also cost the firm millions in lost business. So, instead of giving you the unvarnished truth, they spoon-feed you optimistic earnings forecasts and glowing price targets, designed to keep you in the game and the commissions rolling in. This isn't just a problem for the small-time investor. Institutional investors, the so-called smart money, are caught in the same trap. They're judged on quarterly performance, which means they can't afford to hold cash or make cautious moves. Imagine a fund manager watching from the sidelines as stocks soar. Investors would pull their money faster than you can say, Dow Jones. So even the big players get sucked into the Wall Street optimism machine, buying more and more at higher and higher prices just to keep up appearances. And regulators? They're not much help either. Klarman argues that they actually have a vested interest in rising markets. When stocks are soaring, everyone feels richer, the economy looks healthier, and regulators can pat themselves on the back for a job well done. It's why you see rules that limit how much stocks can fall in a day, but none that stop them from skyrocketing. After all, nobody complains when the bubble is inflating, only when it bursts. So what's the lesson here? According to Klarman, it's to recognize that Wall Street's bullish bias is not your friend. If you blindly follow the endless buy recommendations and optimistic price targets, you're setting yourself up to buy high and sell low. Exactly the opposite of what successful investors do. Instead, Klarman suggests taking a step back and looking at the bigger picture. Understand the true value of the businesses you're buying into, not just the rosy forecasts handed to you by brokers and analysts with dollar signs in their eyes. Focus on downside risk first, how much you could lose if things go wrong, before even thinking about potential gains. Because in a game where everyone else is betting on the market to go up, the smartest move might just be to bet on protecting your capital when it doesn't. Klarman's book is packed with horror stories, and one of the scariest is the junk bond craze of the 1980s. It's a tale of greed, deception, and financial ruin that played out like a Wall Street thriller, with a twist ending that left countless investors holding scraps of worthless paper. Picture this: investors, blinded by the promise of sky-high returns, poured billions into these high-risk bonds, barely pausing to consider the very real danger of defaults. It was like building a financial skyscraper on a foundation of sand, hoping nobody would notice until it was too late. Here's how the scam worked. Companies that were too risky to get traditional loans turned to junk bonds. Essentially, IOUs with sky-high interest rates to compensate for the risk. Wall Street investment banks, sensing a gold mine, marketed these bonds as revolutionary financial tools rather than the ticking time bombs they really were. Investors, hungry for yield in a low interest rate environment, couldn't buy them fast enough. Even pension funds, which are supposed to be bastions of safety, dove headfirst into the junk bond pool. It was like selling parachutes that might or might not open, and watching people line up to jump out of planes. Klarman describes how this greed-driven feeding frenzy inflated a massive bubble, with junk bonds making up a whopping $200 billion market by the late 1980s. Investment bankers raked in commissions, brokers made fortunes, and investors, well, they had no idea they were sitting on a powder keg. For a while, everything seemed great. Prices kept climbing, Wall Street kept cheerleading, and nobody wanted to be the first to stop dancing. Then came the crash, defaults soared, companies went bankrupt, and the junk bond market imploded almost overnight. Investors who thought they were earning easy double-digit returns found themselves stuck with bonds worth pennies on the dollar. It was financial carnage. Fortunes were wiped out, careers were ruined, and the same Wall Street bankers who'd sold these toxic assets suddenly stopped returning phone calls. It was a masterclass in how herd mentality leads to disaster. Klarman's advice? Avoid the crowd. If everyone's buying, it might be time to sell. In fact, Klarman argues that the best opportunities often come when most investors are running for the exits. Think of it as contrarian investing 101. When fear is in the air and prices are plummeting, that's when true value investors strike. But Klarman doesn't stop there. He warns that the junk bond fiasco wasn't some once-in-a-lifetime event. It was part of a recurring pattern on Wall Street, where the names and faces change, but the script stays the same. Just swap out junk bonds for dot-com stocks, mortgage-backed securities, or crypto coins, and the story reads almost word for word. Greed drives investors to ignore risk. Wall Street happily feeds the frenzy, and when the bubble bursts, the only ones left smiling are the bankers counting their bonuses. Klarman's ultimate message is clear. To survive in the market, you've got to be willing to stand alone. That means having the courage to buy when others are selling. And, just as importantly, to sell when everyone else is piling in. It's about patience, discipline, and a refusal to get caught up in the hype. Because in the end, investing isn't about winning the race against other investors. It's about making sure you don't crash before you reach the finish line. It's not just an investing strategy. It's a philosophy, a way of thinking that keeps you from walking into Wall Street's traps. The idea is simple but powerful. It's the gap between a stock's market price and its true value. You buy when the price is way below what the company is actually worth, giving yourself a cushion against mistakes, bad luck, and even a full-on market meltdown. Think of it as wearing a seatbelt when you drive. Or, let's be honest, like having airbags, a roll cage, and maybe even a parachute for your investments. Klarman compares this margin to a bridge. Engineers don't design a bridge to hold exactly as much weight as the average traffic. They build it to hold double or even triple, just in case. Why? Because stuff happens, storms, heavy trucks, earthquakes. Investing, Klarman argues, is no different. If you buy a stock at $50 that you've calculated is really worth $70, that $20 cushion is your margin of safety. If your estimates are off or the market tanks, you're still standing on solid ground. But here's the catch. Finding stocks with a margin of safety isn't easy. It requires patience, discipline, and the willingness to look like an idiot for long stretches of time. Klarman's not interested in the hottest new tech stock that everyone's buzzing about. He's the guy at the estate sale, digging through dusty boxes, looking for a Picasso that's been mislabeled as a print. In a market where everyone else is chasing momentum, he's quietly buying what others are too scared or too greedy to touch. Klarman's margin of safety philosophy also means refusing to pay full price, no matter how tempting the story sounds. He calls it the difference between price and value, two words Wall Street likes to pretend are the same thing. Just because a stock is trading at $100 doesn't mean it's worth $100. In fact, if you're paying full price, you're giving up your margin of safety entirely. It's like going rock climbing without a harness. hoping that your grip never slips. And this isn't just about buying cheap stocks, it's about survival. Wall Street loves to focus on the upside, but Klarman's all about protecting the downside. He knows that in a market crash, the investors who survive aren't the ones who made the most money on the way up, they're the ones who lost the least on the way down. Think of the margin of safety as your life raft. Maybe you won't be cruising on a yacht when the storm hits, but you'll still be afloat. This strategy requires a mindset that most investors don't have. The willingness to be out of step with the crowd, to be the last bidder at an auction when everyone else has already walked away. Klarman says that when the market is euphoric and stocks are priced for perfection, the smart move is to sell, build cash, and wait. Because when the bubble bursts, and it always does, the real opportunities appear. It's a little like sitting in the lifeboat, watching the Titanic passengers argue about whose stateroom has a better view. Sure, you're out in the cold now, but at least you're not going down with the ship. The beauty of the margin of safety is that it doesn't require you to predict the market or time your trades perfectly. It just requires you to wait for deals so good that even if you're half wrong, you'll still come out ahead. That's how Klarman has managed to deliver incredible returns for decades while taking on far less risk than most of Wall Street. So next time you're tempted to buy the latest hot stock, ask yourself, where's my margin of safety? Because when the market turns, and it always does, that cushion could be the only thing standing between you and financial disaster. You're giving yourself room for error because, let's be honest, in the chaos of the market, something's always going to go wrong. Maybe the economy sours, a key customer bolts, or a new regulation hits out of nowhere. Without that cushion, even a small misstep can turn into a disaster. To Klarman, buying a stock without a margin of safety is like driving on an icy mountain road with bald tires. Maybe you'll make it around the curves. Until you don't. The margin of safety is your snow chains, your guardrails, and maybe even an emergency exit ramp. It's about survival first, profit second. This idea isn't just theory. Klarman tells stories of investors who learned this lesson the hard way, like those who bought tech stocks in the late 1990s at 100 times earnings because they thought the internet was the future. Spoiler alert, they were right about the internet, but wrong about the price. When the bubble burst, they were left holding the financial equivalent of confetti. It's the same reason why Klarman prefers dull but dependable companies, think manufacturing, insurance, or utilities, over the latest Silicon Valley darling. Growth stocks might promise the moon, but value stocks offer you a sturdy, well-lit path to the bank. But here's the thing, finding investments with a margin of safety isn't easy. It requires patience, discipline, and a willingness to go against the crowd. Most investors want to buy what's hot, what's moving up. Klarman says that's a recipe for disaster. Instead, he looks for stocks nobody wants, the ones collecting dust at the back of the financial bargain bin. When you buy a $50 stock for $30, you're not just buying shares, you're buying options. Options for the company to turn things around, for the market to regain its sanity, or for a corporate raider to swoop in with a buyout offer. Klarman's advice is clear. Don't just wait for these opportunities, hunt for them. Dig through annual reports, scour balance sheets, look for companies with more cash than debt and assets nobody's paying attention to. When you find one, you pounce, confident that even if things don't go perfectly, that margin of safety will have your back. Because at the end of the day, the market is a voting machine in the short term, but a weighing machine in the long term. If you buy at a deep enough discount, eventually, the market will come around. And when it does, you won't just make money, you'll have done it without losing sleep every time a headline crosses your screen. That's the real power of the margin of safety. It lets you invest with confidence, knowing that even if the road gets bumpy, you've got the shock absorbers to handle it. Wall Street and financial media have trained us to believe that if you're not constantly buying and selling, you're missing out. But Klarman argues that the best opportunities in the market come to those who wait. It's a little like fishing. You don't cast your line every 5 seconds. You find a spot, set your bait, and wait for something worth catching. During the 2008 financial crisis, while everyone else was selling in a panic, Klarman's firm, Bapost Group, was sitting on a mountain of cash. When stocks were plunging, he started buying, slowly, deliberately, at bargain prices. When the dust settled, Bapost's portfolio was up nearly 50%. The lesson? Cash isn't just money. It's buying power. And patience is what lets you use it wisely. Klarman's convinced that most of what you hear on Wall Street, from analysts, brokers, and especially the financial media, is just noise, designed to make you trade. The more you trade, the more commissions Wall Street makes. One of Klarman's favorite stories is about Warren Buffett, who once bought shares in a company after reading its annual report on his honeymoon. While other investors were glued to the latest headlines, Buffett was combing through the footnotes, looking for hidden value. That's what ignoring the noise looks like, turning off the TV, shutting down the news alerts, and diving into the raw numbers. And if that sounds boring, maybe that's the point. Klarman argues that real investing is boring. It's spreadsheets, quarterly reports, and a lot of waiting. It's resisting the urge to chase the next big thing and sticking to the plan, even when it feels like watching paint dry. But here's the thing, boring works. Over decades, boring gets rich. He says to focus on controlling what you can, the price you pay. It's a little like grocery shopping. You can't control if avocados will suddenly cost $5 each, but you can decide to buy them only when they're on sale. In the world of investing, that means finding great businesses at bargain prices and holding on until the market catches up to reality. It's not about being first or fast, it's about being patient and right. But here's the catch. This kind of investing requires patience that borders on stubbornness. Most investors want action, not silence. They want to buy something today that'll pop tomorrow. In his view, the best investors are part-time detectives and full-time couch potatoes, spending months, even years, sifting through financial statements, and then doing absolutely nothing until the market hands them a deal too good to refuse. So, if you're tired of playing Wall Street's rigged game, where brokers are the dealers, analysts are the cheerleaders, and you're just a chip in the casino, then Seth Klarman's margin of safety might just be your new investing Bible. Klarman's philosophy is about something far more valuable: survival. Focus on value, protect yourself with a margin of safety, and remember, investing isn't about getting rich quick, it's about staying rich. That's a whole different ball game. Getting rich quick is about luck, staying rich is about skill, patience, and the discipline to say no, no to the hype, no to the crowd, and no to the urge to trade just because everyone else is. So, if you're tired of the endless noise, the hot tips, the day traders bragging about their latest score, it's time to tune all that out and focus on what really matters: the value of the businesses you own and the price you paid for them. Because in the end, the market might be irrational for a day, a month, or even a few years, but eventually it will come to its senses. And when it does, you'll be glad you invested with a margin of safety. If you found this breakdown helpful, hit like, subscribe for more no-nonsense investment wisdom, and drop a comment if you're ready to ditch the speculation and start investing smart. Until next time, keep those margins wide, those risks low, and remember, sometimes the best trade you'll ever make is the one you didn't. Happy investing!